The reality is your business is going to eat up every dime of money and every ounce of time you give it to eat up. So what we've got to do is we've got to be able to do this the right way, even using things like business credit to be able to do so. Because when we do this, then it basically helps us create a strong foundation where we can create a profitable business. And why that matters is we want to put money in our pocket, right? So running a business, you need to learn to budget, because if you budget and do this right, then what's going to happen is you're going to actually have a lot of profit left over every month, every quarter, every biannual, and every year at the end of the year. And then all that gets like paid to you in distributions, right? So the reason we run businesses is because we want to put money in our pocket, right? We want to be able to create wealth and create financial freedom for ourselves and for our family. But the reality is, if our business isn't profitable, we can't do that. Now, more than likely, if you've been an entrepreneur more than a month, you already know that the reality is most things take longer than we anticipate they will take, and they cost more than we think we will cost us. And so the problem with that is that we typically have this excuse that we are reinvesting in our business, and that's our excuse for never having money left over, right? So we often say, yeah, I take everything I make and reinvest it into the business. Well, that's not necessarily true. In a lot of cases, that's not a voluntary thing. You're not saying, look, my profit margins are 20% of everything we actually collect, we put aside as profit, and then we take all that profit and we reinvest. It's not typically what happens. What typically happens is that you end up making the money, and the money just goes back and gets sucked back into the business without you even intending to do so. And then at the end of every month or quarter or year, you're stressed because you don't have the reserves that get paid to you as distributions, and you don't have the money to be able to grow and expand the business as you want to. Why does this happen? It's really simple. A business will eat up every bit of cash you give it to eat up. It's just like Cookie Monster and cookies. Like, it can't help itself. It'll eat up all the money you have. And it's why we've got to budget. It's why we've got to put profits first, because when we make just some slight adjustments, then what happens is we then have profits left over. We start getting distributions, and we actually start getting paid for all the work that we're actually doing to grow the business. So if you're just coming in, tell me where you're coming in from. I'm going to give you and your business a shout out right here on the live stream. And all the people that are here, and the hundreds or thousands of people that will see this after, you're going to get a free shout out for your business. Pretty cool. So give me your business name. I'd love to give you a shout out. All right. So let's talk about budgeting, right? So budgeting isn't exclusive to large amounts of cash flow. Well, actually, what you want to do with budgeting is you want to start early into launching a new business. You want to get this done. Okay. And for the record, if you don't budget as an individual, I get that. I understand that some people like budgeting, some don't. But budgeting for a business becomes very important because, like I said, a business will eat up every ounce of extra money that it has. So if you really want to create a profitable business where you have reserves for unexpected things and profits you can pull out of the business, then we've got to make sure that we create a budget and determine what we're actually willing to put in there, what we're willing to spend, what kind of money we want left over at the end. So this also prepares us for the unknown. There's really two main goals here for doing this. First of all, we are actually putting money aside for the unknown, for the unexpected, for a shift in the economy. Okay. And these kind of earnings that we have set aside give us the ability to handle the unknown, to prepare for the unexpected. The second part of this is that we want to be able to take money out of the business that we can actually use for ourselves. So for example, one of my buddies owns a tiling business. And at the end of every year, he takes all the money that he sets aside and he buys 1 to 3 properties with it. That's it. He takes the money out, his distribution, he buys properties. And now he has I don't know how many properties, but that's his retirement. Even if he doesn't sell the business and he just shuts down a 2-3 million a year business, he still has millions and millions in real estate that he's used the money at the end of the year to pull out to do. But you can only do that, for example, if you have the actual profits to do so. So it also helps you prepare to confidently manage your cash flow when you need to. So this means that you actually do have the money on hand when you need it. You're not overspending. You have reserves you're building up, and this also helps you become more lendable as well. So, of course, the biggest thing we want to do here is stretch every dollar that we can. We want to make the dollars work for us the more ways that we possibly can do so. And then this opens us up to even more possibilities. So what I mean by that is that by having cash reserves, by having money in hand, by not going paycheck to paycheck in our business, then this makes it easier for us to get loans and credit lines and business credit cards because they see those reserves, and that makes us more appealing. So when we do want access to capital, it's easier for us to get at exactly the same time. And Chris says, hey, I'm from Oak Hill Transportation. Thanks for coming in, Chris. Melody is Advanced Wellness Chiropractic. And Patrick Gibson's in the house as well. And Mr. Frederick Clifton is here from Treja Management LLC checking in. I appreciate you coming in and saying hi. So there's a few different ways to correctly budget. First of all, have a plan. Create a business plan if you don't have one already. Let's outline our goals. Let's outline our projections. Let's outline our expenses. So this helps us have an understanding of like how to budget and what we're budgeting for. It also helps us have a better understanding of the type of budgeting, the amount of money that really makes sense, or the amount of money that we can spend and the amount of money that we actually need to set aside. So we need to define our goals. And let me give you an example. A goal could be that your business is going to have a 10% profit margin or 20% profit margin. So now you're saying, look, my goal is to make sure that this business, if it generates $100,000, that 20,000 of that 100,000 is profit. That is my goal. So that's an example of a goal, is actually setting what your profit margin is going to be, determining what your actual profit is going to be or what you want it to be in the actual business, right? Okay. The other thing we want to do is we want to make sure that we have projections. We have an idea of what we are going to spend for the month, the year, the quarter. And what this allows us to do is determine if we have things that exceed those projections, if we're willing to do them or not. Look, I don't know about you, but I mean, at this point, our business has got pretty big. And the problem is that everybody has ideas and suggestions of how to spend money, and only a fraction of them have suggestions of how to save money, right? But if we literally acted on every single suggestion, or even 50% of the suggestions we get, we would be broke as broke can be. So you have to selectively choose what you're going to spend money on or not. And the easiest way to do this is to create projections. How much are you going to make in revenue? What are the expenses going to be? What is in those norm of expenses? And then the things that are outside of that norm for expenses, you now know you need to make a choice. If you're spending that money, you're going to reduce your profit margin. You're going to have less money to set aside. So maybe you don't want to do that right now. Maybe you want to move that to next quarter as a goal instead of doing it right now. And that's a good way to do it. Create projections for the quarter. If something's going to exceed your expenses, then you might need to make cuts in other areas, or you might need to say no to things this quarter so you're still keeping that profit margin that you've established, that goal intact. Okay, and then you move it to next quarter. And we say, okay, now I'm going to set the budget up for next quarter, and now this thing gets moved to next quarter. It also actually makes it easier for you to tell your team no. So it's easier for me to say to our team, look, this is not in the budget this quarter, but what we'll do is we'll add it to the budget for next quarter. So that makes a lot of sense. And matter of fact, you look more responsible as an owner when you can tell your team, hey, we got a budget. This doesn't meet our budget requirements, or this doesn't meet this. We don't have enough in the budget to get this done. So we're going to move this to next quarter, for example. Okay. And again, it's all about having projections. Now, how do you keep those projections safe so you don't overextend yourself? Well, first of all, categorize things. What are critical expenses? What are things you have to pay? So if we have all those things that we have to pay, what is the most important things to pay? So Dun & Bradstreet, for example, will give you a higher score if you are late on a lower limit account than a higher limit account. So if I'm budgeting, for example, on what credit lines I'm going to pay first, I'm always going to pay my highest limit credit line because that's the most beneficial to my business credit score. Now, it's the same thing with what's critical, what's not. What are critical expenses? What are things that you cannot operate with if you do not have? So, for example, internet. I have to have internet. I cannot run my business without internet. It is impossible for me to run that. That is a critical expense, right? But then there's other things that might not be, like a phone line. I don't need a landline for my business. I could use my cell phone or a voice over IP number or a voice over IP phone if I need to. So what are the critical expenses that if they were eliminated, your business would fail? You could not operate. And then what are helpful expenses? What are things that could help your business run, but not necessarily things you have to have? Now, what I like about this is this helps you in dire times or changes in the economy know exactly what to cut, right? So we see things right now like Salesforce laid off 12,000 people. Microsoft is laying off people. So all these people are getting left. Well, how do they make those decisions? Because they have tiers of prioritization. They understand that when the economy shifts, these people need to lose their jobs. These people need to be laid off. for budget requirements, right? But it's not just people, it's everything you're paying. What are essential expenses you absolutely need to pay? They're critical to the operation. What are just helpful? And let's be honest, what are frivolous? What are the first things that get cut? So meals, for example, do you really need to go out and have all of those dinners that you're having? Or are you really not having a business dinner, maybe having a personal dinner, but talking about business just so it could be a write-off? You got to be honest with yourself. If that's the case, that's one of the first things that gets cut. So when we make cuts here at Credit Suite, meals is one of the first things to go. Unnecessary travel is one of the first things that needs to go, right? That I can go speak at events, I can go do things, but is it really necessary? If not, then it gets cut. So first thing it get cut. But we have different levels of expenses. We understand what's critical. We understand what's helpful. And we also understand realistically what's just frivolous, what's not really needed at all. And these are the first things that can get cut. Okay, determine what you really need. So therefore, you can better determine what you need to cut if you actually do need to make those adjustments, right? And Patrick and Patrice says, hey, P&G Management Group LLC, thanks for coming in. And hello, afternoon, Ty Simplify, brother. Thank you for opening Credit Suite Knowledge. You guys teach is priceless to an entrepreneur in the beginning of their business and for already developed businesses. I really appreciate that. Thank you so much. And you're from New London County, Connecticut. ABCDEFGHI Investing LLC. I appreciate that and I appreciate the kind words. Thanks for coming in. Okay, so you also need to keep your records up to date. So you need to have a P&L sheet. You need to have a balance sheet. Okay, you should go through your projections and keep those up to date. You want to have all of these things up to date because if you ever go to get financing, that stuff's going to be important as well. So for example, a balance sheet shows me how much cash I have on hand at any given time. A profit and loss statement shows me what I'm actually making for this quarter, for this month in profit versus loss. So if I hold myself to a goal, like I'm going to have a 20% profit margin, then the P&L statement shows me how good I'm doing at accomplishing that goal. And if I'm honestly serious about making the profits I want to make in 20% margin, and I get my profit and loss statement and I'm at 10% margin, not 20, well, then if I'm serious, I need to be looking at what I'm going to do to raise my income or cut my expenses to get to 20% next month. So having those up to date also makes it easier for you to be able to get financing as well. When you go to get loans, when you go to get credit lines, when you go to buy real estate or vehicles, they're going to want those financials. And if they're ready and up to date, it makes getting money super fast. When we get SBA loans, we oftentimes now get them within 1 week's time. No exaggeration. We can go get an SBA loan or credit line and close on it within 3 weeks, oftentimes in less than a week, because all the income documentation they ask for, we have ready to go. So that makes it easier for you when it comes time to getting loans and credit lines as well. And then you also want to categorize the expenses and you want to make sure that you're creating tracking for these expenses as well, right? So there's a lot of different options, whether it be QuickBooks, whether it be so many other different options, Ramp. There's so many other options that are out there, a lot of which, like Ramp, reports to the business credit reporting agencies. Okay, D&B, Equifax, and Experian. So they help you manage all of these things. And at the exact same time, they also are helping you build business credit at the same time. And a lot of these services will have separate cards you can get as authorized users for your employees and automatic ways to get the expenses into your accounting software. So again, these things are so helpful. So I have QuickBooks on my phone, their app. And it's been a tremendous game changer for me because I used to keep all my receipts. I don't keep my receipts anymore. Now when I get a receipt and I'm at a restaurant, that I take a picture of it and upload it right into my actual QuickBook app. So now I don't have to manage paper receipts anymore. Everything is uploaded and then it's easily accessible if I ever have an audit or I ever need to access that at any point in time without carrying around paper receipts all the time. So again, categorizing those expenses and managing them, even using things like Ramp where you can actually build business credit at the same time, are hugely beneficial as well. The next thing you want to do is you want to use credit wisely. So we want to use business credit to help us budget. And what I mean by this is that, is that if I say I want a 20% profit margin and I'm only at 10% this month, well, then maybe next month I want to move some more money onto revolving credit cards. And then I don't want to come out of pocket. I want to maintain my margin of 20%. And then that gives me time to pay that stuff off over time because I'm running an advertising campaign that's going to give me some other kind of result, for example. So what I mean by that is, let's say that I've determined that I want my profit margin to be 20%, which means $20 out of every 100 I collect is getting set aside and it's put aside for profit. Well, let's also say that I'm going to run a Facebook ad campaign that was not within my budget this month. But if I run that Facebook ad campaign, I'm confident that it's going to get me a return in 60 days. Not this month, I won't make a profit, but in 2 months, I will make a profit. Well, in that scenario, in order to protect my margin, I might want to use business credit to pay for that actual campaign. Then I don't have to pay that until it's actually getting me a result and a return. Now I'm accruing some interest, which is tax deductible. But the nice thing about that is I can maintain my margin at 20%. And then as the thing I'm investing money into that's out of my budget is getting a result and a return, then I can take that return on my money and then I can pay off that actual revolving credit. So using credit just lets you decide what and when you pay things. You should always use credit to pay everything you can pay, because there's cash back and there's rewards points on credit. So that means, like, for example, Ramp, I don't know why, I met with them yesterday, so they're on the top of my head. They give 1%, 1.5% cash back on all spending through them, right? So if you get their corporate card, they give you 1.5% cash back. Well, that's not a little bit of money. I mean, if I'm spending like, $100,000 a year, or $100,000, well, that's an extra $1,500. That's just free money for me. And so many of them give you double, triple, quadruple rewards points and cash back. So using credit cards gets me rewards, it gets me cash back, and it lets me spend the money and not come out of my pocket, out of my bank account. Then I can pay off that credit as I'd like. So it just makes it easier for me to actually come in and be able to protect my margins that I actually want. That's my goal, is to have a certain margin, let's say. It helps me protect that margin. And then I determine when I pay off that credit, and I'm getting points and cash back for all my spending. And I can even pay off a lot of that credit before interest accrues. Or even if interest accrues, it's okay, because I'm still writing that off at the end of the year anyways, right? So that makes it easier for us to manage our money when we're using business credit to be able to do so. Now, you're no longer limited to only a percentage of your business cash flow. In this case, right? So you can, this basically, when you're budgeting using business credit, it unlocks your ability to expand the business while still having enough cash in hand. So it helps you protect margins while still using credit to actually invest in the business. Look, debt is really hard to avoid in a business. As an individual, you can. There's bad debt like credit card debt you may want to avoid. Okay. But the reality is that in a business, a successful, healthy business has debt. Apple has a lot of debt, $100 billion. Amazon, a lot of debt. They all have a lot of debt. They use other people's money to grow. That's strategically using your money to grow and keeping the cash on hand for things you need cash on hand with. So if we use Walmart as an example, biggest retailer in the world, 80% of what they put on their shelves, they're using business credit to buy. That lets them keep cash on hand. They use the cash to expand and open new locations. Those new locations make them money, and then they're taking that extra money and paying off the debt that they're actually accumulating, right? Apple's the same way, right? So Apple uses business credit for everything they can. They keep their cash for research and development. Then they research a new product, they release it, they make tons of money, and they use the money to pay off the debt. This is how every one of the biggest companies in the world operates. It's smart use of debt. And by putting things on business credit, it basically does that for you. It gives you full control, right? And that's what this really comes down to. You are the one choosing the budget. You are the one using credit to actually manage all of your expenses and trying to use all of your cash. And you are the one that can determine the profit of the business. Now, there's a great book called Profit First that you should check out. Okay, a lot of us run our businesses based on Profit First. And what Profit First says is, hey, look, determine what you want the profit to be and take that money out and set it aside, and then you pay your expenses after that. Now, you might say, well, I don't have enough money left over to pay my expenses. It doesn't typically work out that way. What I mean by that is, if you've ever had money debited from your paycheck, for example, okay, maybe you got a 401k or whatever it may be that you have money taken out of a normal paycheck for, you usually don't notice that money gone if it's gone right from the beginning. So Profit First allows you to decide what your profit margin is, set that money aside, and then you actually, at the end of the quarter or month or year, have all of that profit there. You even have a separate account to pay taxes. Now, you don't have to worry about taxes. Your tax money has already been put aside. Now you have profits. Then you can use those profits and pull them out. And then you decide, maybe you want to put some of the profits back into the company. Maybe you want to put all the profits in your pocket. Okay, at Credit Suite, we put a large amount of our profits back in the company. Part of those go to the company. Part of those go to shareholders. Okay, one of my buddy's businesses, 100% of the profits he pulls out of the business. So again, every business is different. You determine, are you doing a distribution and taking profit out every month, every quarter, biannually, annually? You determine that, And again, you determine the percentage. You might say 40% of the money we're going to pull out, 60% we're going to keep as what we call retained earnings, keep the money in the business, or it might be a different percentage. But again, those kind of things are very helpful for you to be able to establish and then know. So then at the end of the year, quarter month, you actually have money to distribute to yourself. And look, that's hugely beneficial. When you're pulling out 5 grand, 10 grand, 50 grand, 100 grand, then all of a sudden that's your vacations, that's your kids' college funds, that's all the money that you need, but it only works if you get this budgeting part of this down. Okay. So Patrice says, hey, is this segment being taped? It is. You are attending on YouTube. So if you go to YouTube, this will be available for playback on our YouTube channel. And Monday Melody says, first time live. I appreciate you coming and joining us. So we are here every Tuesday and Thursday at 1 o'clock Eastern. I appreciate you coming in, and I appreciate you coming in and saying hello, everybody. So thanks for tuning in. I'm going to go ahead and wrap up. If you'd like to talk to us more about getting business credit, credit lines, loans, to kind of be able to help you fund your business so you don't have to take all your cash and do that, then make sure you get in touch with us. You can go to creditsuite.com/consult. That's creditsuite.com/consult. You can go back and play this on the channel of your choice, Facebook, YouTube, LinkedIn. You just go back to the page that you're watching it on. You can watch the replay as well. So I look forward to seeing you on Thursday, where we're back here at 1 o'clock, where we'll talk about more cool ways for you to be able to get money and save money to be able to use to grow your business. Thank you for tuning in.